The Intelligent Investor, the definitive book on value investing by Benjamin Graham. Have you ever felt it? That knot in your stomach when you look at your investment account? That frantic, almost addictive need to check the stock market every single day, maybe even every hour? You see the news, you hear the hype, you see tickers flashing green and red, and you're caught in a storm of hope and fear. Hope that you'll pick the one stock that makes you rich, and fear. A deep, gnawing fear that you'll make a mistake and lose everything. It feels like you're gambling, doesn't it? Like you're sitting at a high-stakes poker table in a Las Vegas casino. But the strange thing is, nobody ever taught you the rules. You're just bluffing, hoping for the best. What if I told you that this entire feeling, the anxiety, the confusion, the gambling, is based on a massive illusion, a trap that almost every single person falls into? What if there was a way to step away from the casino table forever, and instead become the calm, confident owner of the casino itself? Well, get ready, because in this audiobook review, we're going to dismantle that illusion piece by piece. We are diving into what the legendary investor Warren Buffett calls by far the best book on investing ever written. We're exploring Benjamin Graham's timeless masterpiece, The Intelligent Investor. This isn't a how-to-get-rich-quick scheme. In fact, it's the exact opposite. Graham himself says this book is not for traders or speculators. This is a guide to getting rich for sure, slowly, calmly, and without the stomach-churning stress. This is your blueprint for achieving financial freedom and, more importantly, financial peace of mind. By the end of our time together, you won't just know how to invest. You will understand the fundamental mindset that separates the calm, wealthy investor from the anxious, struggling speculator. You will learn how to turn the market's madness into your greatest advantage. Are you ready to discover how? The guide out of the maze. Who was Benjamin Graham? So, who is this guide who promises to lead us out of the financial maze? Who was Benjamin Graham, and why should we listen to him? Imagine a man who experienced the absolute extremes of wealth and poverty. Graham was born in London in 1894, but his family moved to New York when he was a baby. They lived a life of comfort on Fifth Avenue, complete with maids and a governess. But when Ben was just 9, his father died, the family business failed, and they slid into poverty. Can you imagine the sting of this? Young Ben once had to cash a $5 check for his mother, and he never forgot the humiliation of the bank teller asking, "Is Dorothy Grossbaum good for $5? His mother, desperate to reclaim their fortune, started borrowing money to trade stocks, and was completely wiped out in the crash of 1907. Graham learned about the dangers of the stock market not from a textbook, but from raw, painful, first-hand experience. But here's where the story turns. Graham was brilliant. He won a scholarship to Columbia University and graduated second in his class at just 20 years old. 3 different departments, English, philosophy, and mathematics, offered him a faculty position. But he chose a different path. He chose to face the beast that had wounded his family: Wall Street. He started as a clerk and quickly rose to become a partner, eventually running his own hugely successful investment firm, Graham Newman Corp. From 1936 to 1956, his firm returned at least 14.7% annually, crushing the market's average of 12.2% and becoming one of the best long-term track records in Wall Street history. But here's the crucial point. Graham wasn't just a great investor, he was the greatest thinker about investing. Before Graham, Wall Street was like a medieval guild, driven by superstition, guesswork, and gut feelings. Graham transformed it into a modern profession, a discipline based on logic, evidence, and reason. He wasn't just playing the game, he figured out the physics of the game itself. And he poured all of that wisdom, all of that hard-won experience, into The Intelligent Investor. He wrote it to give ordinary people, people like you and me, the emotional framework and analytical tools to succeed. So when we listen to Graham, we're not listening to some academic in an ivory tower. We are listening to a man who felt the pain of loss, who dedicated his life to understanding the psychology of the markets, and who created a logical, repeatable system for building wealth safely. He is the perfect guide. The Great Deception. The investor versus the speculator. Let's start with the most important question Graham asks. What does it even mean to be an investor? This is where the trap is first laid. Wall Street has deliberately blurred the lines. They call everyone an investor. The day trader clicking his mouse 100 times a minute? An investor. The person buying a hot stock they heard about at a party with no idea what the company even does? An investor. Graham says this is a mischievous, dangerous confusion of terms, and he gives us a beautifully simple, crystal clear definition to cut through the noise. Are you listening closely? This might be the most important sentence you hear today. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's break that down. It has three simple parts. Thorough analysis. You must study the business. You must understand the facts. Safety of principal. You must protect yourself from serious loss. An adequate return. You are aiming for a satisfactory return, not an earth-shattering one. Anything, and I mean anything, that doesn't meet all three of these criteria is not an investment. It is speculation. So what's the difference in mindset? An investor calculates what a stock is worth based on the value of its business. A speculator gambles that a stock's price will go up because someone else will be foolish enough to pay more for it. The investor judges the market price by standards of value. The speculator, on the other hand, bases their standard of value on the market price. Do you see the trap? The speculator is a puppet, and the market's daily mood swings are the strings. For the speculator, the stream of stock quotes is like oxygen. Cut it off, and they die. But the investor is the master. Graham says you should only buy a stock if you would be comfortable owning it even if you couldn't see its price for 10 years. Think about that. If the stock market shut down tomorrow for a decade, would you be terrified? Or would you be perfectly content owning your share of a great business? Your answer to that question reveals whether you are an investor or a speculator. And guess what? Wall Street wants you to be a speculator. Why? Because every time you trade, they make money. It's like a casino. The flashing lights, the exciting sounds, the stories of big winners, it's all designed to get you to play the game, to trade more and more. But the odds are calibrated so that the house, your broker, always wins in the end. But here's the beautiful part. Investing, as Graham defines it, is a unique kind of casino. It's the one casino in the world where you cannot lose in the end, as long as you play by the rules that put the odds squarely in your favor. Let's look at a story that proves this point beyond all doubt. Even one of the most intelligent human beings who ever lived fell into the speculator's trap. In the spring of 1720, Sir Isaac Newton, the genius who discovered the laws of gravity, owned shares in the hottest stock in England, the South Sea Company. He sensed the market was getting crazy, and he wisely sold his shares, making a 100% profit. A fantastic result. But then, he watched as his friends who stayed in kept making more and more money. The hype, the excitement, the fear of missing out, it got to him. Just months later, swept up in the wild enthusiasm, Newton jumped back in at a much, much higher price. And what happened? The bubble burst. And Sir Isaac Newton, the man who could calculate the motions of the heavens, lost $20,000. That's over $3 million in today's money. He was so devastated that for the rest of his life, he forbade anyone from even speaking the words South Sea in his presence. So if you've failed at investing so far, it's not because you're stupid. It's because, like Sir Isaac Newton, you haven't yet developed the emotional discipline. You've been playing the speculator's game, The good news is, from this moment on, you never have to play that game again. Meet your erratic business partner, the parable of Mr. Market. So, if we're not supposed to listen to the market's daily chatter, how should we think about it? Now we get to one of Graham's most brilliant and powerful ideas. It's a simple metaphor that will completely change your relationship with the stock market. I want you to imagine that you are business partners with a man named Mr. Market. Every single day, without fail, Mr. Market shows up at your door and offers to either buy your shares in the business or sell you his shares. But here's the thing about your partner. He's a manic depressive. Some days he is euphoric. He sees nothing but a golden future for your business. On those days, he quotes a ridiculously high price for your shares and begs to buy you out. Other days, he is plunged into despair. He sees nothing but trouble ahead. On those days, he shows up crying, offering to sell you his shares for pennies on the dollar. Now, here's the most important part of the deal, Mr. Market doesn't mind if you ignore him. He'll be back tomorrow with a new price. You are under no obligation to trade with him at all. His mood should not and cannot affect your view of the business's actual value. What a bizarre partner, right? But now think about it. Who in their right mind would sell their shares to Mr. Market just because he's euphoric and offering a silly high price? And who would frantically sell their shares to him just because he's depressed and quoting a ridiculously low price? Nobody. That would be insane. You would take advantage of him. When he's depressed, you'd happily buy his shares for a bargain. When he's euphoric, you might consider selling your shares to him if his price is truly absurd. But you would never ever let his mood dictate your actions or your feelings about the business. And yet, what do millions of people do every single day? They let the real-life Mr. Market, the stock market, tell them how to feel. When the market is euphoric, they feel euphoric and rush to buy at high prices. When the market is panicking, they panic and rush to sell at low prices. They let this crazy, manic depressive partner dictate their entire financial destiny. They are his emotional slaves. The intelligent investor, Graham teaches us, reverses this relationship. The intelligent investor is a realist who sells to optimists and buys from pessimists. You should be happy when your stocks go down, because it means Mr. Market is offering you a bargain. You should be wary when they go up, because it means they are becoming more expensive. Do you see how profound this is? This simple story frees you forever from the tyranny of the market. You don't have to predict its moods. You don't have to analyze its every twitch. All you have to do is remember that the price is just an offer from a crazy partner. It is not a verdict on the value of your business. Your job is to wait patiently for the days when he is in a deep funk and offers you a screaming bargain. From now on, when you see the market plunging, you won't feel fear. You'll smile and think, "Hello, Mr. Market, what kind of a sale are you offering me today?" The one rule, to rule them all, the margin of safety. Now, if you have this new, liberated mindset, you still need a practical tool to guide your decisions. How do you know when Mr. Market is offering you a true bargain? How do you protect yourself from making a huge mistake? And here we arrive at the central concept of Graham's entire philosophy. He calls it the most important 3 words in investing. I want you to burn them into your brain. Margin of safety. What is the margin of safety? The logic is so simple, so powerful, it's almost shocking. In simple terms, the margin of safety means never overpaying for an investment. It means buying a stock for significantly less than you think its underlying business is worth. Think about it like building a bridge. If you calculate that a bridge needs to hold 10,000 pounds, do you build it to hold exactly 10,000 pounds? Of course not. You build it to hold 20,000 or 30,000 pounds. That extra capacity is your margin of safety. It protects you from unexpected stress, from calculation errors, from bad luck. It's the same with investing. No matter how careful you are, the future is uncertain. Your estimates of a company's value could be wrong. The economy could tank. A new competitor could emerge. A war could break out. You cannot eliminate the risk of being wrong. So, how do you protect yourself? With a margin of safety, let's say you analyze a company and conclude its business is worth $100 per share. Do you buy it at 99 years or 95s? No. An intelligent investor using a margin of safety might wait until the price drops to $60 or $50. That $40 or $50 difference between the value and the price is your margin of safety. What does this margin do for you? Two wonderful things. First, it cushions you against losses. If you were wrong and the company's value is actually only $70, you still bought it at $60, so you haven't lost money. If bad luck strikes and the value falls, your purchase price is so low that the damage is minimized. Second, and this is the beautiful part, it gives you a massive upside potential. You don't need things to go exceptionally well to make a good profit. You just need things to go not horribly. And eventually, the price is likely to rise toward its true value, handing you a handsome return. Graham states that the central secret to investment results can be summed up in this motto: margin of safety. And don't you find that concept just flows through so many areas of life? We apply it everywhere else. We don't tailgate the car in front of us. We look both ways before crossing the street. We bring a spare tire on a long road trip. Yet when it comes to our life savings, we often throw all caution to the wind. The speculator buys stocks because they're going up. The investor buys stocks when they're on sale. The speculator focuses on what the price might do. The investor focuses on what the business is worth. And the margin of safety is the bridge between those two worlds. It is the discipline of buying with such a significant discount that it's hard to lose money over time. This isn't about being a genius. It's about being disciplined. You don't need a stratospheric IQ to do this. What you need, as Graham says, is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. The margin of safety is that framework. It's your shield against emotion and your secret weapon for long-term success. Can you start to feel how important this is? The two paths, a simple plan for lifelong success. Okay, so we have the mindset. We understand Mr. Market and the margin of safety. But how do we put this into a practical, real-world portfolio? What do we actually do? Graham, in his wisdom, knew that not everyone wants to spend their weekends poring over financial reports. He knew that most people have lives to live, families to raise, and careers to build. So he divided investors into two types: the defensive investor and the enterprising investor. And I want you to listen very carefully, because for 99% of people, the defensive path is the key to wealth and serenity. The defensive investor. The defensive investor's main goal is simple: avoid serious mistakes or losses. Their second goal is freedom from effort, annoyance, and the need to make constant decisions. Sound good? I thought so. The plan for the defensive investor is beautifully, almost ridiculously, simple. It has two components: a stake in bonds. Graham recommends you always have a portion of your money in high-quality bonds or bond-like investments. He suggests this should never be less than 25% and never more than 75% of your total portfolio. Bonds act as a stabilizer. When stocks are crashing, bonds tend to hold their value or even go up, acting as a shock absorber for your portfolio and your nerves. A stake in stocks. The rest of your money goes into common stocks, but not just any stocks. The defensive investor must confine themselves to the shares of important companies with a long record of profitable operations and in strong financial condition. Think of the big, stable, blue-chip companies you know and trust. And what about the split between these two? Graham's simplest suggestion is to just maintain a 50-50 balance. Half in bonds, half in a diversified group of large, stable stocks. Once a year, you look at your portfolio. If stocks have had a great year and now make up 60% of your holdings, you sell some stocks and buy some bonds to get back to 50-50. If stocks have had a bad year and are now only 40%, you do the opposite. That's it. That's the entire strategy. It's genius, isn't it? It automatically makes you buy low and sell high, without any emotion or guesswork. It's a system, a discipline. It takes the decision-making, the anxiety, the temptation right out of your hands. And today, it's even easier. You can achieve this with just 2 low-cost index funds, a total stock market index fund and a total bond market index fund. You can set up your financial life in about 15 minutes a year. This is not a path to spectacular overnight wealth. It is a path to a creditable, certain, and stress-free accumulation of wealth over a lifetime. The enterprising investor. Now, what about the other path? The enterprising or aggressive investor is the person who is willing to devote significant time and effort to researching and selecting individual securities that are more attractive than the average. But Graham gives a serious warning here. He says that if you just try to bring a little extra knowledge and cleverness to your investing, you are more likely to do worse than the defensive investor, not better. Why? Because you open yourself up to all the classic mistakes: chasing hot stocks, overtrading, and thinking you're smarter than the market. For the enterprising investor to succeed, they must follow policies that are both inherently sound and promising, and not popular on Wall Street. This means looking for bargain issues, like companies selling for less than the value of their working capital, or getting involved in special situations like mergers. It is a full-time job requiring immense skill, patience, and emotional control. So what's the takeaway? Be honest with yourself. Are you truly willing and able to become a full-time, expert security analyst? For most of us, the answer is no. And that's not a failure, it's an incredible liberation. By admitting you are not a stock-picking genius, you can adopt the simple, powerful, and almost foolproof strategy of the defensive investor and get on with living your life, knowing your financial future is secure. The crystal ball is always cracked, the folly of forecasting. The future of security prices is never predictable. That's not some random guy on the internet talking. That's Benjamin Graham, the greatest investment thinker of all time. And yet, what is the entire financial media industry based on? Forecasting, predicting, telling you what the market will do next, and the public eats it up. We desperately want someone to tell us the future so we can feel safe. But Graham shows us, with a century of data, that this is a fool's errand. Let's look at one of his most powerful arguments. He says that obvious prospects for physical growth in a business do not translate into obvious profits for investors. What does he mean? Let's take a trip back in time. In the late 1940s and early 1950s, what was the most exciting, can't-miss growth industry? The airline industry. It was obvious to everyone that air travel was going to explode. The future was brilliant, and so people piled into airline stocks, paying any price to get a piece of the action. So what happened? Did these investors get rich? Not at all. Despite spectacular growth in revenue, even greater than the computer industry, the airline industry has been a financial disaster for investors. A combination of intense competition, high fixed costs, and technological problems meant that profits were terrible. In fact, over its entire history, the cumulative earnings of the airline industry have been negative. Now fast forward to the late 1990s. What was the obvious growth industry then? The internet, of course. And the story repeated itself, but on a much grander scale. Experts fell over themselves to make insane predictions. In 1999, one fund manager predicted his internet fund would gain 35% per year for the next 20 years. Another manager, Alberto Villar, ridiculed anyone who doubted the internet. He said, "You're in a horse and buggy and I'm in a Porsche. You don't like tenfold growth opportunities? Then go with someone else." Well, guess what happened to his Porsche? If you had invested $10,000 in his fund at the end of 1999, by the end of 2002, you would have had just $1,095 left. It was one of the worst destructions of wealth in modern history. The lesson is not that you should avoid exciting industries. The lesson is that by the time an industry's growth is obvious to everyone, the prices of its stocks have been bid up so high that there's no profit left for the investor. The fantastic growth has already been priced in. The party is already over. So, the next time you hear an expert on TV confidently predicting that the next sure thing is clean energy or biotechnology or artificial intelligence, I want you to hear Benjamin Graham's wise voice in your ear. Remember the airlines. Remember the dot-com bust. The intelligent investor never bases their decisions on forecasts. They base them on discipline, analysis, and a margin of safety. They know the only thing you can predict about the market is that it will surprise you. And it will most brutally surprise those who are most certain about what's coming next. Your new North Star. Final thoughts on a liberated life. We've covered a lot of ground. We've exposed the trap of speculation. We've met our crazy partner, Mr. Market. We've armed ourselves with the margin of safety. And we've discovered the simple, powerful path of the defensive investor. So what is the ultimate lesson of the intelligent investor? It's that your financial success depends less on how your investments behave and much more on how you behave. The book is a masterpiece not because it gives you hot stock tips, but because it gives you a behavioral operating system. It's an inoculation against the financial diseases that plague almost everyone: greed, fear, impatience, and arrogance. Let's quickly recap what we've learned. We've learned that an investment is not a stock, it's a piece of a business. And it must be bought with a margin of safety. We've learned that the market is a manic-depressive partner, Mr. Market, whose moods are there to be exploited, not adopted. We've learned that trying to forecast the market is a recipe for disaster. The future is, and always will be, unpredictable. And we've learned that the simplest path, a disciplined, automated portfolio of stocks and bonds, is the surest path to wealth and peace of mind. Now, I'm going to ask you a few questions to see how deeply these ideas have settled in. First, the next time the stock market has a terrible day and drops 3%, what is your first thought going to be? Is it going to be fear? Or are you going to smile and ask, "Mr. Market, is that a sale I see?" Second, when you hear about a hot new stock that everyone is piling into, what will you do? Will you feel the fear of missing out and be tempted to jump in? Or will you remember Sir Isaac Newton and the South Sea Bubble and calmly walk away? And finally, what are the three most important words in investing? That's right, margin of safety. It is your shield, your guide, your key to sleeping well at night. If you can internalize these lessons, you will have done more for your financial future than 99% of the people out there. You will be free. Free from the anxiety. Free from the noise. Free from the constant pressure to do something, anything, with your money. This audiobook review has only scratched the surface of the wisdom in The Intelligent Investor. If this has resonated with you, I urge you, do yourself one of the biggest favors of your life and get the full book. Read it and then reread it. As Warren Buffett says, it gets better every time. Don't stop here. Your journey of growth has just taken a massive leap forward. Continue it. Embrace the mindset of the intelligent investor, not just in your portfolio, but in all areas of your life. Be patient. Be disciplined. Think for yourself. And you will not only survive, you will thrive.